Hello. In this video, we're going to be talking about receivables, specifically the write-off method versus the allowance method. So we're going to be talking about, we've talked about previous in other videos recording accounts receivable and the amount we should be recording it at. Now, so the accounts receivable is a right to receive payment, right? We sold a product or a service and now on credit, and we sent an invoice and we're owed money. However, in the real world, not every single dollar that we booked as accounts receivable we're actually going to get, right? Various reasons why our customers may not pay us at all. They might go bankrupt, they have their own problems, that they're cash strapped, whatever it is, we're not going to receive 100% of what we booked as our accounts receivable, most likely. And so these costs, they're called credit losses or bad debts. They're just a cost of granting credit. When we allow people to buy products on credit, it's just a cost. It's really a cost of any company. So the question is, how do we account for the fact that not every dollar of accounts receivable is going to be collected? And there's two methods. The first method is the direct write-off method, which is not allowed by GAAP, but it is for tax. It's required for tax, and the allowance method. So we're going to spend more time on the allowance method in this video. But just quickly, the direct write-off method is exactly what it sounds like. We wait until a particular accounts receivable is deemed uncollectible, and at that point, we just write it off. And the way we write it off is that we would credit our accounts receivable for whatever that amount we deem we are actually not going to collect, and we debit what's called bad debt expense, and that goes on your income statement. Now, this method is not allowed for GAAP, but it is required for tax for most companies. Why? Why is it not allowed for GAAP? Well, similar to estimating sales returns, if we just do, if we did allow the direct write-off method, it would overstate the balance in the accounts receivable, right? Because now our accounts receivable is at 100%, but we know we're not going to collect 100% of those amounts. And it over-reports our net income because we should really have an expense for those losses, and it actually postpones the recognition of that expense until the period where the customer actually fails to pay. And that's not right, because we know for a fact that we're going to have to book this bad debt expense at some point, and so we should be able to estimate that. And so really that brings us to the allowance method, which is what is required by GAAP. And the way we do this is we introduce another contra account, and this time it's a contra asset account, and it's called the allowance for uncollectible accounts, also known as more commonly as the allowance for doubtful accounts. That's what you'll see in a lot of financial statements. But the allowance for uncollectible accounts or allowance for doubtful accounts, it's the same thing. It's the same account, and it's a contra asset account to the accounts receivable. And what it does is it reduces the carrying value of the accounts receivable to the amount that we actually expect to collect. And when you present the balance sheet, you present both amounts. You present your total accounts receivable, and you present what your allowance for doubtful accounts are. So here, this is a net number because it says accounts receivable less allowance for doubtful accounts for $203. So we know that the gross accounts receivable is $203 higher than this. So like I said earlier, the allowance account, we don't wait until we actually write off accounts receivable until they're actually, when we know that they're not going to be collectible. We have to estimate how much of the accounts receivable we don't think will be collectible, and that's when we record our bad debt expense. So the bad debt expense is actually recognized earlier, right, than the direct write-off method because we're estimating how much will be uncollectible. Later, when we see, okay, this account is actually not going to be collectible, then we just have really a balance sheet transaction between accounts receivable and the allowance for doubtful accounts. And we'll go through that. So let's go through an example. Hawthorne Manufacturing Company started operations in 2027. It had sales of $1.2 million and collections of $895,000, leaving a balance of $305,000 in accounts receivable as of December 31st. So we started zero, we made sales. So this would be debit. I just want to go through the journal entries so you get used to these. This 1.2 would have been debit, accounts receivable, credit sales, right? That's this 1.2 million. And then sometime during the year we collected that. So we would say debit cash, 895,000, and credit accounts receivable, 895,000. So just so you see. And so at the end of the year, we still we're saying, okay, we still have $305,000 left to collect. Okay. Hawthorne's analysis indicates that it expects to collect $280,000, not the $305,000 of its accounts receivable. So therefore, it has to establish an allowance for uncollectible accounts for $25,000, right? The difference between the 305 and 280. The way we do that is we book an expense called bad debt expense for $25,000. So we increase our expense and we credit this allowance for uncollectible accounts. Remember, this is a contra asset account against accounts receivable. So accounts receivable has a normal balance of a debit is a normal balance for accounts receivable because it's an asset. So the allowance for uncollectible accounts, their normal balance is the credit because it's a contra asset, it's the opposite. So when we look at and it goes on our balance sheet. So when we look at our allowance for uncollectible accounts for this year, we started at zero and then we debited bad debt expense for 25 and we credited this account for 25. So here you see the credit and we have a credit balance at 12/31 for $25,000. So now roll forward to 2028. On April 24, 2028, Hawthorne concludes that it's not going to collect $15,000 of the accounts receivable from a customer that recently has gone bankrupt. Well, let's look at this. So we already booked allowance for doubtful accounts or allowance for uncollectible accounts for $25,000, right? So our starting point at 1/1/28 is a credit balance in this account for $25,000. And our accounts receivable is at the gross amount. It's booked at 305, and then we have the allowance of 25,000. They're booked in two separate accounts. So our accounts receivable still shows $305,000 on a gross basis. Now we've accounted, we said, okay, this 15,000 is for sure we're not going to collect it. So once we know, because the allowance for uncollectible accounts is what we think we're not going to collect. Now we know for sure we're not going to collect $15,000 of this amount. So now we can actually reduce our accounts receivable by the $15,000. So we're going to debit this allowance for uncollectible accounts by $15,000, and basically we're going to move it to reduce our accounts receivable. So that way our accounts receivable account now has a balance of $290,000 because now we know for sure it's not an estimate that we're owed, right? We have accounts receivable of $290,000. So this is just ends up being, if you will, a balance sheet reclass of sorts between two balance sheet accounts. Let's just say that of this $15,000, we were wrong. We thought for sure we're never going to get that $15,000, but something happens and a assume Hawthorne learns on May 30th that the financial situation of its customer that we booked the $15,000 write-off has improved, and it's going to be able to collect $1,200 of the receivable that was previously written off. So now we have to because our accounts receivable is 290,000, but actually we think we're going to be able to collect 291,200. So we're going to debit our accounts receivable by 1,200, and the other side is going to be the reinstatement of this allowance for uncollectible accounts. We're still not sure if we're going to actually collect it. It's just they're telling us that yes, we can pay you, but we're still not sure. So we're just going to reverse a portion of our previous entry that we booked in the previous slide, this $15,000. Of this 15,000, they're telling us that we're going to collect 1,200, so we're just going to reverse $1,200 of this 15,000 in when the write-off is reinstated. This is called, this allowance method is a balance sheet approach. And the reason why it's a balance sheet approach is because we look at our accounts receivable, and then we look at our allowance, and we say, okay, our accounts receivable is going to be at a gross amount. Let's just say it's at $100,000, and we think that 10% of it will not be collectible, so we credit our allowance. And really, the way we record our allowance is through bad debt expense. But it's called the balance sheet approach because we are looking to see what, at the end of the day, what do we think we will actually be able to collect? What should our asset be? And then we adjust our asset via the bad debt expense. But anyway, this is just called the balance sheet approach.